Good morning. Thank you for joining us today. My name's David Widmar. I'm a Senior Research Associate with the Purdue Center for Commercial Agriculture. And today we're talking about the crop outlook and management strategies. I'm joined today with Dr. Chris Hurt, Professor in Agricultural Economics, and Dr. Michael Langemeyer, the Associate Director for the Center for Commercial Agriculture. Today we're going to be going through a series of outlook and strategy sessions in light of recent conditions and changing environments. If you have any questions throughout today's webinar, I invite you to email me at dwidmar@purdue.edu. I'll be monitoring those throughout today's webinar, and as we have time, we'll jump on and ask these questions to Chris and Michael. And if we don't get to your questions during the session, we'll follow up later today or throughout the week. Wow, what a great time to have a webinar. What a June. I think June will be very memorable. One of the things that comes to mind is higher prices. The last 2-3 weeks, we've really seen a rocket ship in the price markets. That's really been fueled by lower stocks from 2014, lower acres for 2015, and in adverse weather, lower yields, the potential for lower yields, and lower reduced acres, and the thought of preventive plantings. And that's what Chris and Michael are going to help us walk through today. They're going to tell us what the USDA report from yesterday, which sent commodity prices higher for corn and soybeans and wheat, what that said, what we still are unknown and what we're still worried about. And Michael's going to walk us through what are some of the implications for producers for this year and for the next couple years as well. Before we jump into it, I wanted to show this chart to really recap what's been going on since June. So around June 1st, this is for soybeans. Soybeans were trading around $9. We jumped up a little bit and revisited that about middle of the 10th of June. But man, since the 10th of June, we've gone from around $9 up to close to $10.40 yesterday. So that's a really big jump. And again, those three factors: reduced acres, reduced stocks, and the potential for reduced yields. So Chris, do you want to walk us through a little bit about what our current situation is in the grains?
Yeah, obviously surprise, I think, to all of us that, we had the ingredients out there with the weather concerns that we had, but probably the stocks would be the other ingredient that made the dynamite go off. But really those three factors, I think, are all key here. And for corn and soybeans, they all went in the same direction. Let's start out with the stocks. And the stocks probably was really the foundation or the one ingredient that if you'd had the stocks with the weather that we already had, that would have ignited the market. And we look at, first on corn, the expectation on going into the report of the trade was that the stocks number on corn would be about 4.512 billion bushels of corn. That actual came in at 4.4. But of course we look at the difference, 65 million bushels of corn. Again, you think, okay, we are looking at a carryout of 1.8 or so 65 million, that's less than 100 million. Maybe that shouldn't be a huge number, but obviously it was a number that said that by itself means perhaps we're going to tighten stocks from the 2014-15 marketing year. Now again, I put that price impact down there. My guess would have been just that number by itself. It was friendly, 8, 10, 12 cents a bushel would be my guess. So we've got some complementary things going on to have got that market up the 25, 30 cents we had. Over on the soybean side, much more significant, that difference from the expectations of the 625 million bushel actual number, that was about 50 million bushels lower. Now when you get down to carryovers that are more in the 400 million range, 50 million out of 400, this is starting to be a fairly significant number. So I put just a bullish guess on here. Nobody knows what that number would be, but maybe 25 to 30 cents, not a 50 cent up kind of a market. So I think the stocks is one of those. We have to add additional bullishness on the acreage side. So we'll look at the acreage numbers, and we have the USDA March 31 numbers on corn, 89.2 million acres. the expectation was that we would be down just a little bit, but we actually, from that expectation, we're down a little under 300,000 acres. Now, again, this isn't a huge amount. That would represent maybe something in the range of 45 million bushels, but we had 65 million less stocks, less corn than we thought, and that acreage would reduce another 45 million bushels, so there's 110 million bushels less. Certainly the same direction. Over on the soybean side, USDA was 84.6 million acres back in their March first survey of farmers. The trade thought it would be down, and again, I thought we could be down over 1 million acres. What we saw was that we were down, but not much different than what the trade had expected, 400,000 to 500,000 acres from the March report, or from what the trade expected, just 50,000 acres. Now that's really not anything in terms of 50,000 acres is 2 million bushels roughly of production. So the acres on soybeans in the acreage report really didn't add much to the price. So we're saying acreage is important. So where that's going to come in is when we look at this weather. It is the wet weather, the lack of planting, the delayed planting that we're getting on soybeans. How many acres are going to be prevented? We're going to have to talk about that just a little bit.
Now, Chris, just to clarify here, this actual June 30th number, that was based on survey in early June.
Yeah.
So that acreage is not a final number by any stretch.
Yeah, and a great and really important point, and that is when NASS does the survey, they ask the question to producers, how many acres of corn have you planted and do you intend to plant? Same on beans, wheat, etc. So let's make sure we caught that intend to plant. So these numbers are reflecting not only what the farmers had in the ground, they're reflecting what they're still intending to plant. Survey done around the 1st of June. So Michael's point's really important. Intended to plant acres are in here. And that's where we have to say now we're to July with a number of these acres on beans still not planted yet. So what is going to be the impact on prevented planting? And we're also going to talk a little later about another impact on acreage, and that is on harvested acres. And this relates to particularly the ponding areas that we have, flooded areas along creeks and rivers, and the areas that are ponded that are not going to be able to be harvested because there's no crop left there. If they can't get that replanted, there's no crop. How does that show up? It shows up as it was planted, but it's not harvested. So this reduces harvested acreage. That's what counts for production, is harvested acreage. So we still have two parts of acreage, prevented planting as well as what's the harvested acreage going to be. And we're not really going to know those numbers until we get out probably to October, November, and on into next year.
So the stage was set with this latest report that acreages are lower than what they initially expected, and we still have two parts of the story left to be told later this fall. So definitely something to keep our eyes on.
That's right. I think it says, along with the weather that we'll talk about here in a second, a lot of uncertainty going forward, and that probably means volatility. If we can look at the state breakdown, this was a graphic from USDA yesterday on the release of the report. This is corn acreage, and the states in red had reduced corn acreage from last year. Reduced corn acreage, you can see particularly in our big states, eastern corn belt states, we elected farmers are saying less corn. You get out in the western corn belt states, Iowa, Minnesota, North Dakota, as well as Nebraska and Kansas, and what you see is no change. They pretty well stayed with their corn program. And so I think we have one on beans, and you'd kind of expect an opposite direction on beans since the prime corn belt is heavily corn and beans. The states in blue increased soybean acreage. The states in red reduced soybean acreage. So here again, we see the eastern corn belt especially going heavily for beans and reducing corn, and then at least here the far western corn belt states reducing corn acreage a little bit. And Michael, you'd run some numbers on this, I think, not necessarily this, but looking at the comparative advantage
You look
of
at the
corn and
relative
beans.
competitiveness of corn and soybeans, and it really changes as you go from the western corn belt to the eastern corn belt. Specifically in the western corn belt, particularly in Nebraska and Iowa, corn seems to be more competitive compared to the states in the eastern corn belt, particularly Indiana and Ohio, and that's what you're seeing right here. You're seeing some pickup of acreage in soybeans compared to corn in Indiana and Ohio, as well as Illinois. And so it's not real surprising.
And that's probably related to relative yields. Would you say
Yes,
that would be the
relative
single
yields
most?
and actually relative prices too tend to favor corn, and particularly in Nebraska, but also in Iowa.
And probably that may have changed with the ethanol plants. 'Cause
Yes.
you're in ethanol
Yes,
country.
there's a lot of ethanol plants in Nebraska and Iowa, particularly eastern Nebraska and Iowa, and so both of those factors really favor corn to a greater extent in Nebraska and Iowa compared to Indiana and Ohio in particular, but also Illinois.
And I can remember pre-ethanol days, and I shouldn't say just pre, but the last surge, if you go back to 2000 as an example, before we had the really big surge starting in 2006, 7, 8, that you'd think about northwest Iowa could be 30-cent lower prices than kind of our central Indiana. Boy, that's not true anymore. Those are very competitive, and so I think that really has changed that mix.
And to clarify, the map here and the previous map were part of the release from the USDA.
That's correct.
And so the speculation about preventive planting and where the acres are falling a little bit behind now we're going to talk about that now.
Yeah, and so again, acreage is a very important part of production. It's not just yield, it's acreage, and as we look at this delayed planting, what we have here is on soybeans. This would be the number of acres of soybeans that these states are behind their normal. That's the 5-year average that NASS reports each week. So as we look at the worst of the problems, and I think everybody around the grain markets knows, it's Missouri on soybeans, and they're looking at about 1.8 million acres that they're behind on soybean plantings compared to where they normally would be, and the normal is the 5-year average. And again, it's not just Missouri. We know that is the eastern Kansas area. It's southern Illinois, and then parts of Nebraska on the east side. You take those four states, 2.7 million acres in those 4 states, with the bullseye sitting right over Missouri. And this begins to give us a proxy for how many of these acres may never be planted this year. Now again, we don't know that number. We're not going to know that number for some time, but I think clearly on beans, we're 2 million plus acres that may never get planted, and that is prevented planting, and then we have to go to the harvested acres that'll never get harvested. So again, I think, on beans, we can be over 3 million acres from those numbers that USDA reported on that got planted that may never make it to harvest.
And that number from Missouri really stands out. That's a very unique situation in Missouri. They tend to have prevented planted acres, don't get me wrong, but not to the magnitude of what we're looking at on that slide.
Yeah, and you'd looked at some of that data by state.
500,000 would be a big number.
For Missouri.
For prevented planting, and it looks like it could be considerably larger than that this year.
Right now they're behind about 1.8
Yes.
million. So I know my brothers.
And that's just behind. That's not.
That's not
They
prevented
still have
planting,
a lot more beans than that
but
to
there
plant.
still could be a chunk of that, a pretty large
I
chunk
think
of
that's
that
right.
prevented
Yeah,
planting.
you're from Kansas.
I know
so-
my brother's in eastern Kansas and probably in the bean planter right now. June 30th was their late planting date, so they've crossed over into that date. But I do know with the price rally, a little bit more optimism to get the beans planted, even though they're a little behind the schedule.
Yeah.
So we'll see how
so
these
the price does give greater incentive. Okay, we can go a little later and get a more reduction in yield.
Yep.
So good point. This is the history going back to 2007 of the total acres in the U.S. Soybean acres that ended up in prevented planted acres. And I think what we're looking at is the 2013 year. Again, this is the national data, 2 million acres in 2013. Farmers across the country just declared we can't get them planted. And this year, our soybean planting is still running a little bit behind 2013. So I think this is the best measure we have, something above 2 million acres that will be in the prevented planting category. For soybeans, could that be 2.5 million? I think that's very possible. That could be $2.5 million acres. And then we have still the implication of the drowned out acres that could be on top of that can't get harvested. So this is 3 million plus acres on soybeans. That's a big number in terms of what that production around the country is finally going to be.
Because we're around 80, 85 million acres of soybeans planted in the country.
Right,
That's
so correct.
3 million acres of prevented planting or drowned out planting is going to add up as a large percentage.
Yeah, and Michael, you made the point, where are those acres this year, especially thinking about the flooding in the eastern
Yeah, really,
Corn Belt.
the prevented planting acres have really shifted this year. Typically, a lot of the prevented planted acres are north of South Dakota and Minnesota. There's usually quite a few acres in that area that are prevented planting. This year, it's shifted south with the focus on Missouri, but also Kansas, and I was reading someplace southern Illinois, Tennessee, some of these areas, and so in Arkansas. So the prevented planted acres have really shifted south this year, following the heavy rainfalls that we saw in these areas.
And we have some pretty high quality, especially in central northern Illinois, Indiana, Ohio, some pretty high quality land in terms of yieldability. Not the highest, but some pretty good land that's been underwater. So I think it is, versus the Dakotas, normally where you expect to see that, shifted south.
And also the flooding out.
Land.
I mean, those million acres or whatever the number that your estimate, there's quite a few acres in very good soybean production areas that are flooded out, and so that's also going to have a big impact. And so I think it's safe to say that there's a lot of uncertainty with respect to soybean price right now, Chris.
Another measure sometimes we look at is the crop ratings, and there is a category that's the worst category any enumerator can put a crop in, and that's very poor. And our best estimate on that very poor is it's in really bad shape, could be close to gone. We have 2% of both corn across the major states that report and soybeans are in that very poor category. 2% of like 80 million acres, that's 1.6 million acres.
Yeah.
So again, I think, those numbers are going to be pretty high when you add those, especially in beans, to prevent plant, plus then the crop that's just drowned out. So this is going to be a mystery as we go on through the summer, but the market's got to believe there's some pretty important numbers on the lost acres side of things.
So we could definitely, for soybeans at least, be challenging the highs we saw in 2013. It's in a different region of the country, so definitely something we're going to keep our eye on. What can we learn from the weather? What's going on with the weather? It's been wet here in Indiana. What's going on across the country, and what does it look like moving forward in the next couple of weeks?
We have here the percent of normal precipitation. This is the 30-day percent of normal. And I think there's kind of three things that I see in this, because I think it's reflective of maybe the whole growing season. The first one that is dominant to us here towards the eastern side of the Corn Belt is the deep blue and purple that you see from Missouri, eastern Iowa, headed across Illinois, Indiana, and into western Ohio where their big yields and better crops are. Too wet, and so that is 200 to 400% of normal precipitation. The darkest purple, the dark blue is 150 to 200%. Now that's a 30-day total. So we know this area has a lot of flooding, it has the ponding, it has excess moisture, it has nitrogen problems. Some nitrogen never got on corn. Some of that, a good bit of nitrogen in that area is leached out. So when can they get back in? When can they put that nitrogen on? And we did a farm tour, that we all were involved with last week, and we were in some of those purple areas in Indiana, and some really bleak corn, almost white. Never saw corn as close to white color, not just yellow, white almost, and that's nitrogen, just really too much water. So we do have these major problems. Now, the second area then I have kind of watched is the southeastern United States. There you see more of the orange and brown showing up. Not all the area, but certainly dryness. And last 30 days, that's kind of reflective of the season so far. And what that says is it's been hot, it's been dry. Had that Bermuda high locked in for them for a good bit of the first half of June, and that makes those crops vulnerable. The third area I think we're going to watch very closely is the northwestern part of the Corn Belt. So I'm on up to Minnesota, South Dakota, and that northwest quadrant of Iowa. And right now that area looks very good, as well as eastern Nebraska. But you see some oranges and browns, and that also reflects, as we go back to the late winter and spring, kind of drouthy conditions. Just didn't get the subsoil recharged up in that area. Now again, it's been relatively cool. We haven't had the heat stress, but we know setting on up in Canada, as we get to the prairie provinces, particularly Saskatchewan, they are drouthy. And drought has a way of moving. If that moves on into that northwestern part of the Corn Belt, we could still be looking at trimming some yields there because it's just the subsoil moisture isn't built up. So those are the three areas for corn and beans I think we still have to watch very closely. And we've got another 6 to 8 weeks of watching this weather to see the impacts. I think we've got kind of the next 7-day forecast. And again, the bullseye is down Missouri. Have we mentioned Missouri before? But
they're still trying to plant beans, right? So they might have some hope to plant a few more beans, but
in the water,
7 days is not going to be too helpful.
So you can see
Southern Illinois is in that
Southern
Illinois
Illinois, and getting pretty far south. But those again, a lot of that rain's coming through in the next couple days. But you know, there's 5 to 7, 8 inches of rain in that bullseye area. Now, what I'd say about that is, oh my gosh, we think that's the Midwest. But you'll notice that's really very southern tip of Illinois, Indiana. And those amounts, as you get into central and northern Indiana, are actually not excessive at all. And Iowa's not excessive. So I think this is not so terrible to our corn and bean yields. But there's still plenty of water around, that's for sure. Then we're going to look at, this is the 8 to 14 day forecast that's currently from the National Weather Service. The green this is precipitation, and three things I mentioned. Where it's wet, the green continues wet. For the Corn Belt, that's from Kansas, Missouri, southwest Iowa, Illinois, Indiana, Ohio. That's continues wet. Where it's too wet, it continues too wet. Look at the southeast. Where they're a little bit on the dry side, it dries out. Look at the northwest part of the Corn Belt, the Dakotas, Minnesota, it dries out. So those three areas all look to me like the forecast, this is the 8 to 14, are saying continued potential weather problems in those three areas.
So it's still a little early to understand what exactly the implications for yield are, but we have the crop ratings. What have they been saying lately?
Well, and again, this gives us a lot of clues to prices. And if you think corn and soybean prices are overpriced, look at the quality of the crop in Iowa. This is corn ratings by week. 83% currently in Iowa over on the left-hand side of your visual. 83% is rated in the top two categories, good or excellent. So it's an excellent crop overall, at least visually, in Iowa. And you can see they started out darn good, 80%, and they basically have increased or maintained that. The other one to look at in the Western Corn Belt we have up here is Minnesota, about the middle. These are ranked by the size of the states. Iowa, the biggest corn state, Illinois, second, etc. 81% of Minnesota, just looking wonderful. And again, improving. Now we look at what indicators we have from the Eastern Corn Belt. Look at Illinois, second from the left. Starting out just like Iowa, 80% basically, 79%, good and excellent, a wonderful crop, a great start, and now the last 3 weeks going lower and lower and lower. The problems are in the Eastern Corn Belt. It's getting reflected in crop ratings. And then, of course, Indiana, even a greater decline, little bigger problems early on in Indiana, 76% rated good and excellent, down now under 50% good and excellent. Again, we've got 4 to 5% of our crop in very poor, both corn and beans, and that's saying probably near gone. So I think this reflects a great start in the Western Corn Belt, even improving in some of those states, and really declining in the eastern corn belt. And so when you put the whole country together, the U.S. over on the right, we have seen decreases the last 3 weeks. They're not real sharp, but they are decreases. And when we look at these rankings relative to the last 15 to 20 years, the national corn crop is ranked pretty close to normal at this point. So if you want to come up with what do you think your trend yield is, I'd say that's about what my guess would be. If you USDA is 166.8, so I'd say that they don't have a lot of reason to lower that in the July estimate if they're looking at crop ratings. And we'll have another crop ratings again next Monday before they come out with their data. But right now, I've got the national crop just slightly below a normal crop.
So it's one of those years where it could be average. It's looking like it's going to be an average crop, but we have two tails. We have an area that's doing really well in the west, and in the eastern corn belt we have areas doing not as favorably. And so looking out your back window and making your marketing decisions based off the back porch probably isn't going to be the best strategy. We need to look at the country as a whole.
I think that's a great point, that we don't want to get too localized here in our thought process. And then we've tried to highlight the three areas we know for corn and beans. It's eastern and western corn belt are the big issues. If that western corn belt starts to dry out, you're going to really see further movement to the upside on the corn and soybean price. If the eastern corn belt starts to improve and the western corn belt holds, then these prices will probably be difficult to hold. Same kind of thing on beans. And I think the points are very similar here. We have a little different ranks in terms of the state that are the top 6 states. And you'll notice Missouri a little over halfway past, a little bit on the right-hand side of halfway. Started off bad, been trouble in Missouri from the start, and no improvement in that, and little decrease. I think the other thing we notice from this, again, western corn belt doing very well or even improving, eastern corn belt falling off sharply very quickly. But overall, the ratings on soybeans are not as strong as corn. And I think this is what we hear often and recognize from agronomists and from all farmers who observe corn and beans. Corn got off to a pretty good start and had more height and could handle some of that excess moisture. Soybeans really struggled with the excess moisture, so little, hard for them to recover. Again, on this bean crop, when we go over to the U.S., we've got it pretty close on the crop ratings compared to the last 15 to 20 years, pretty close to normal, just slightly under a normal crop. Again, same issue, very good crop of western corn belt, problems in the eastern corn belt.
And looking at the national yield a little more in depth, a little more detail, you have right here now the corn national and the soybean national yields and kind of how things have progressed through the month of June based on the crop conditions.
Yeah, Dave, we do use these crop ratings, as many other analysts do, to try to come up with an estimate of what that might mean to yield. Now, what we have to say is that is just an estimate, and it's kind of an average of the last 15 to 20 years. What is the crop rating at the end of the year, and what does that end up being with yields? So these are not highly accurate, but I think what it does is at least gives us an indication of the change in yields. And so let's look at a normal situation for corn. That's in the middle graphic, and we're looking weekly. We talked about these big declines in the quality of the crop in the eastern corn belt over the month of June. So we go back to the first week of June, and these are based on my estimates. I've got a normal crop of corn at 165 bushels nationally. Now remember, USDA is a little higher than that, 166.8. So this is subject to opinion, and not to say they're wrong, not to say anybody else is right, but at least I felt they were just a touch high. So I'm using the 165. We go back to early June, and my yield estimates with a normal at 165 were coming out that the national crop was 167.7 based on these estimates, so a couple 3 bushels above average. Now with a 165 normal at this week's crop ratings, we're a little under that 165, 164.7. So the yield projections I'm going to use are based on the 164.7. If you use USDA numbers of 166.8, then they're going to have a little more production. Over on the soybean side, I've got a normal yield at about 45.1 bushels. USDA's came out a little more optimistic, 46 bushel national average yield with kind of a normal weather scenario. And you can see that decrease on a national basis is not huge, 0.7 of a bushel from the first observation in the first row down to the last. But certainly you can see the direction, overall reductions. Now I think we've got a visual on Indiana. Of course, we're some of our viewers in Indiana, and we do try to keep up as the land grant of Indiana. And here we see a bigger impact, just what you would guess. Crop ratings start off good. We've got a normal Indiana crop at 172. Started off early. Boy, did we have a lot of promise. We're up there 6 bushels above the normal, and things are looking good. We're rolling, and then the water comes. And the excess water, you can see these write-downs, and so that's a 15 bushel write-down on these estimates since the early June period, down to 160, roughly 163 bushels. Soybeans, same direction. We didn't have the data for Indiana in early June, but picking up there mid-June, June 14th, from about 53 bushels down to 49.5, 3.5 bushel reduction. Some people would say you're crazy, we're not going to have any yield in Indiana. On their farm, there are serious farms with trouble, but still we do have some. 58% of our corn and beans were ranked good or excellent this last week. So we've got the dichotomy even within our own states.
And I think the central strip there probably is not quite as good as the far north and southern Indiana.
That's
too,
correct.
Chris.
And it would be really far north.
Yeah.
Because we do have a really bad band, sort of a Kankakee to Fort Wayne, if you think what that means. Really bad band of drowned out area.
So people in that area, they're probably thinking this impact you're showing is too small, but you got to remember this is for all of Indiana.
That's right. And we do still have, as you said, have 58%. That's not quite 60, but you know that is a considerable number that's still rated in the top 2 categories. So we've got the dichotomy, and I think, Dave, you made the point. Look out your back door and make your marketing decisions. Better not do that this year.
Right. So we have lower yield estimates coming in preliminarily. We have lower stocks. We have reduced acres.
And we got this weather that doesn't really look too good.
And the weather's not helping us out. So how do we put all this together, and how do we make some sense out of that as to what it might mean on the farm for prices
Well, of course,
this
the
year?
traditional way that both USDA and most of us as land grant analysts, we try to put that into production and usage and come out with what does this mean to the bottom line in terms of ending stocks. So we have here the first 2 columns of numbers, USDA for the 14-15 marketing year, and then what USDA's projections are in these are the June estimates in the WASDE report for 15-16. Then I just put 1 column up for 15-16. The 3rd column, and so we can look at the contrast. Where do we differ? Now let's remember, with this new information, the stocks, the acreage, USDA will revise the next WASDE update that'll be coming 10th, 11th, 12th of July. I haven't checked that date exactly, but coming up in another roughly 10 days. So they will make revisions to both 14 and 15. But we start out by looking at the stocks number. So you'll see the stocks number that USDA has for 15-16 crop, 1.876, that the reduced stocks that data that came out yesterday, USDA says, well, there's less corn than we had anticipated, so that either means greater use in the 14-15 marketing year, or maybe the crop size was smaller back in 14. They can't change the crop size until they get more information after the September stocks report, so that'll be on into October. So this means they're going to have to put this 50, 60, 65 million bushels into greater use. Now, I just reflected that as less carryout, that they will reduce the carryout for 14-15. That is the incoming stocks for 15-16. And I just put 56 million bushels. less, and that's the stocks number. We'll see how close they come to that 65 million bushels. And then the big difference here that I have is I have lower yields, and some of that is weather, but I also have lower trend yields. And then I've tried to make a little reduction in the expected corn harvested acreage. I think that's, I reduced 200,000 acres. I took their planted acreage that they had from yesterday's report, but I reduced, then harvested another 200,000 acres to reflect some of this drowned out area. And I think that's pretty conservative. I think that number could be a little higher than that. And so there's 306 million difference. And so a lot of what I have is the stocks coming in and then the smaller production. Will USDA lower their yield in this July update? I'm not sure. That's not clear yet. They're going to have to look at that crop ratings report, see what happens on the weather, and it's possible that they could reduce yield for the 15 crop, but it's going to be because they're convinced it really is lower. So we just don't know if they will or not. But anyway, let's go down to the bottom line, and that is the ending stocks. The ending stocks, 15, 16, USDA, and this is very preliminary. In May and June, when you're making estimates for a crop that's just being planted, wow, there can be a lot different. 1.77 billion bushels, and that is bringing that carryout down. If you like a little higher prices, that's headed in the right direction, bringing that carryout down. With my adjustments, I've got that on down to about 1.4. Very bottom of that visual, you'll look at the stocks to use, and that is what are the volume of stocks in relation to the total use as a percent. USDA's number is 12.9%. I'm dropping down to 10%. These are pretty substantial reductions in that carryout. And that's enough to go from saying there's plenty of corn in the world, the U.S. is going to have another great crop, to saying, oh my gosh, there's not as much as we thought. And if we get some more surprises, either greater use or smaller crops, we could be starting to need to ration the usage. We don't have to ration usage with these numbers, but the next event that lowers production or increases use, yes.
So just a few months ago, in 2014, we had 1.8 billion bushels. Go ahead.
Yeah, I was going to say.
We had fear of a big crop. We had fear of a lot of acres. And so that 2 billion bushel number was floating around out there as kind of a concern. And so now we've seen kind of a turn of the tides, and now we're going the opposite direction where we're closer to 1.4 based on your estimates.
I think that's the key point here, that in having enough and then a little bit more just put you in surplus category. And I think this turns that and you know, why did you get such a reaction in the market yesterday? I think you sort of moved across from we got plenty and you're not going to have to worry to, oh my gosh, this is different than we thought.
And that's reflected in your price estimates.
It is, and again, we'll see where USDA will increase, I think, price for the 15-16 crop. They've been at 3.5. A lot of us have felt that was too low. Even in the last 2 months, I think we've felt more like 375, 380 corn was more of a accurate price. Nobody knows. I think they'll come up. Now again, not likely they'll come up to 4.25 until they really have more evidence on yield. But I think that 4 to 4.25 price is a very realistic number. And if you don't believe me, go look at what futures are trading at yesterday afternoon and this morning. That's basically what the market said. Yeah. And again, we go back and look at the 350 corn, and we've really seen this kind of predominance of USDA to have these, even in their 10-year projections, what really seem like very low prices to a lot of us. Not that we're going to bounce back to $5 corn, we think, but closer to that $4 mark. That's what I think we saw yesterday. That's what the market said.
And to foreshadow a little bit about what Michael's going to talk about, $4 is an important number for producers to keep in their mind.
Well, I think so. It's a nice round number for one thing, and it's easy to remember that number. But I think Michael's going to talk to us about it's not just the price of corn, it's their cost.
Right.
And so these two got to get in better balance sometime. Just quickly on the usage side, I've got pointed there the arrow. that our current projections on exports of corn are a little bit higher than where USDA is. That's the purplish line. I think we still could end up with exports a little stronger. USDA could put some of that 65 million bushels into higher exports. And then the next visual, similar kind of thing, the dark black line, that's weekly grind for ethanol. And it's actually gallons of ethanol produced, not the bushels. But the point is the black line, almost all those weeks, pretty well above last year's pace. We're running over 4% pace this year, year to date, on corn use for ethanol. Now again, what's going to happen for the last 2 months, we could trim that level of being above last year. I still think we could have a higher grind for ethanol. So USDA could put some of this smaller amount of corn, that 65 million bushel less, they could put it over in ethanol. They may want to wait a little bit. Best guess, what are they going to do with 65 million? There's 65 million bushels less. They'll probably stick most of it in the feed and residual. Residual means we don't know where to put it, so that's where it goes from now. Just a quick look at the stocks to use down on the bottom. That X to the right is where USDA had been, about a 13%, and that they were coming up with around, over on the vertical scale, $3.50 corn. We now move back to around that 10%, the left red arrow, around 10%, and if you were on the green line, that's actually up in the above 450 corn. Again, I think we'd be more in this 4.25 range at this point. And another point I think, Dave, to make is look what happens to prices as you drop down to 9 or 8%. You're getting into a category where things could really take off on the upside. That's what we saw yesterday. It was this moving from we got plenty and you're going to have low prices to, oh my gosh, we're getting closer to that point on the left side of this visual where things could take off, and we got weather threats still out there. We got uncertainty about acreage. So we still got a long ways to go with this crop year.
It'll be an interesting one to keep an eye on, because as you pointed out, we could move a lot just with a little bit of change, especially in this ending stocks to use.
That's right. A lot of uncertainties out there. Just a chart on corn. Again, this goes back the last year. This is new crop corn, Dees corn, and where we were, this is afternoon close yesterday. You can see 440 up there. Those were the highs basically in the last year. Markets sometimes like to go back and retest those highs. That might be an objective for some old crop corn. If we can hold this 430, overnights we're up just a touch. I think this gives us a lot of incentive to cash in some of that old crop corn, and we think farmers are holding on to more than usual. Can we go above that? Sure, you can go above that, and we've outlined some of the reasons. Also, weather can change very quickly, so we have to keep that in mind. And especially as I think about it for my situation, when I sold cash corn at $3.60 a bushel, that's a lot more down towards the bottom. Now this is futures and it's new crop, but when I think about that, this is so much better opportunities that at least letting go of some of that old crop makes a lot of sense at this point. We got the move. Let's make some decisions to cash in on that. Now again, we got these Eastern Corn Belt farmers that are saying, but I'm losing a lot of my 2015 crop. And what you see oftentimes there is they have this say, I'm losing my 15 crop, I've got to make it up with higher prices of some of that old 14. Be careful with that. Yeah. Look at those national numbers. We better talk beans a little bit.
Let's talk about the beans a little bit.
Won't go into the detail here, but again, we had about 50 million less stocks. So I've reflected that in less carry-in that we'll have for the 15-16 crop, about 45 million. Again, I've got a little bit lower bean yields. And then I'm also picking up, I was pretty conservative. I dropped harvested acreage about 1.5 million acres from what USDA's harvested acreage would be. Now again, I've already said I think we'll be over 2 million on prevented planted. So I think this could be 3 million. I think I'm pretty conservative on taking the bean acreage down, and that's 100 million. So 150 million bushels, less supply, a little bit of tinkering with the usage, but let's go down to the carryout, roughly reducing carryouts maybe 150, 160 million bushels. Look at the very bottom line, stocks to use, USDA's 12.7 to 8.4. These are very substantial reductions. 100 million, 150 million bushels on bean carryout of 475. These are big numbers. And so I've got beans at about $10.50. And again, if you think that's a crazy number to talk about, just look at the futures market, how quickly it said, oh wow, we've just been way off base.
And this has really changed the economics between corn and soybeans, because we were talking 15, 16 being a bean year that was not going to be a very good price. All of a sudden, we add $1.25, $1.50 to these beans. That really changes that relative price relationship.
Good point. We often hear that farmers say, the incentive in the spring is to plant beans. What will it be in the fall when I have something to sell? And that your point is sometimes it doesn't work out that way.
It's important to keep in mind that 6 months ago we were looking at building stocks. The 14 estimate was at 8.8% stocks to use. We were looking at building that. The USDA got us close to 13%. Now we're looking at something more like 8.4%. So we're not growing the ending
and that
stock.
percent could come down.
Well,
like
we're talking about these
earlier.
vulnerabilities, and boy, you could have 3 million less acres on those beans. I put 1.5 million, and you're getting up there in the vulnerable, and you get 1 or 2 more things to reduce yield. I had the question from the media yesterday. What will happen to the demand side? And the first thing you think about is the world buyers have been sitting on their hands. There's plenty of grain and soybeans in the world. We'll buy hand to mouth. They're getting cheaper. They're getting cheaper and cheaper. Wait. Let's see what happens now when they start, oh my gosh, I've missed my buying opportunity. So these are going to be really interesting days in the market for us to work through. Soybean chart looks a little different than corn going back to last year. Remember, corn, we still had looked like a little upside. Beans achieved that yesterday, that 1040. This is on the new crop soybean futures. You'd sort of guess the market needs to take a bit of time to digest now. That it's going to be really hard to trade above roughly this 1040, 1050 until we see more damage or see more evidence that there's a more bullish situation. So again, I think on old crop beans, some still out there. I think, get those, at least a portion of those moved on this opportunity that we have.
Okay, well, thank you, Chris. This has been a lot of information, a lot to digest, but
and a lot more to look forward to.
A lot more to look forward to. It seems like this fall we'll really start to get a lot of that sorted out when we get some yield estimates and some concrete numbers on planting and preventive planting. But Michael, we're gonna think a little bit about what the producers should how they should view this and how they should adjust their
Let's talk about
systems.
a couple things. First of all, let's talk about adjustments in cash rent based on the information that Chris was talking about. I'll have a chart on that next. But also, let's also talk about where break-evens are likely to land up in 16, 17, and 18. From when you're buying assets, for example, land or machinery, you need to think long term. And so let's look at the break-even prices going out there to 16, 17, and 18. First of all, there's a couple big assumptions I'm making here for 16, 17, and 18. I'm using trend yields for those years, and 15 I've actually reduced the yields based on the wet conditions in Indiana. I've also declined cash rents in 15 and all the way through 18. But all other costs are held constant. So that's a big assumption, but that's what I've done here. The only cost I'm adjusting is cash rent. So let's look at that chart, David. And what you see here is based on lower net return to land that we're seeing today compared to 2-3 years ago. I'm expecting cash rents to decline slowly until they get to about that $230 amount. This is for West Central Indiana, so very high quality ground in that part of Indiana. But I'm expecting cash rents to drop from 20 to 25%. But of course, this is all predicated on corn hovering around $4 for a long-run equilibrium price. If corn is higher than that, then these cash rents certainly would not drop this much. And so this is based on corn gravitating towards $4 as we move out to 16, 17, and 18. So remember this when I show you my break-even prices. So if we look at corn here real quickly, with those drops in cash rents, we're looking at a break-even price for corn going out 16, 17, and 18 around $4. So that's kind of a long-run equilibrium price.
That on the bars.
Yeah, that's on the bars. And the prices are similar, so you're looking at kind of a break-even situation for 16 and 17 and 18. predicated on my assumption of dropping cash rents. If those cash rents do not go down, our break-even prices would jump to $450. Essentially, and so that's the difference here between some break-evens I was showing earlier in the year and the break-evens here. These break-evens assume that cash rents are going to come down. Also notice that the margins do not look very good, particularly in 14 and 15, but also 16, 17, and 18. There's nothing to write home about there in terms of margins. The price is right on the bar, so about break-even. Contrast that to 2010, 11, and 12, where we saw some pretty big margins there. Those days look like they could be over unless corn would shoot up to $5 or so. Those days look like it's over, at least for a while, at least for the foreseeable future.
Could you explain real quick what happened in 2012? We had the break-even price.
Obviously,
really
the drought there. You're using a case farm like this, the case farm's yield dropped to about 110, 120, and so you're going to have a high break-even price with a lot lower yield. The trend yield for this farm is 180.
So important takeaway for producers out there is that assuming they can get their cash rents negotiated lower, $4 is kind of a break even.
Yes.
Chris said that $4 might be in the range of possible expectations, but if we were to see farmland corn prices jump up a little bit, it might be a little harder for them to negotiate those.
Definitely. If corn price gravitates towards $450, I don't think cash rents are going to drop 20%. It's as simple as that. And so there is a very close relationship, I think, to corn and soybean prices and where these cash rents end up.
Now, this is a pretty high quality farm, isn't
Yes,
it?
this is above average
And
productivity.
what would you say average cost in Indiana would be somewhat higher than this farm?
Definitely a quarter higher.
So maybe
425,
450.
Yeah,
range.
425 to 450.
Yeah.
So it's very important that producers keep an eye on their costs in the environment. So, and even though we have a jump in prices, we're just barely getting to that break-even point.
Now, you also, I think, an important assumption was that all other costs,
are constant.
seed, fertilizer, chem, fuel, machinery, family labor, all that stays the same.
Yeah.
Does that mean they shouldn't worry about trying to drive those costs
No.
lower if they can?
We definitely should try to lower those costs if possible. It's just very difficult to forecast what those prices are going to be.
Right.
And so, yeah, it's certainly very, very important to look at seed cost per acre and per bushel and try to keep those costs as low as possible. Using the best science there, like we talked about in an earlier webinar. Same with fertilizer, making sure you control those costs, because if those costs are higher, then your break-evens are obviously going to be higher.
What if USDA was right and corn's going to be $3.50 a bushel for the next? What does that mean to cash rents?
That looks really sad from a net return standpoint, and in that case, you're looking at cash rents dropping perhaps 30%.
Okay, so you move
scenario.
well beyond that
Yes.
2025.
Yeah, because you're looking at negative margins in that case of $50 to $100. Similar to what we were in 14 and 15. Soybeans is a similar situation. The break-even price here gravitates towards $10. I've shown that in the charts for 16, 17, 18, the bars. Here, this is a couple days ago, the prices here, and so the prices are going to go up a little bit. Those triangles will actually go up more towards the top of those bars in 16, 17, and 18. So looking at close to a break-even equilibrium price for soybeans on the above-average productivity ground, again, of about $10. And so keep in mind that $4 and $10, those are break-evens that I'm showing here in this case farm, and so producers can compare their break-evens to that. That's something to shoot for anyway. Again, it's a lot different situation than we saw in 10, 11, and 12, but it's certainly a better situation for beans in 16, 17, and 18 than we saw in 15.
So this year, producers, a lot of times with the crop budgets, it looked like soybeans were going to be a little bit more advantageous than corn. Looking to the 16, 17, 18, how does that break out?
Let's go to the next chart here, David. This shows that quite well. I've been saying for the last 2 years or so that beans were a good crop compared to corn for Indiana, and that bears out in this particular chart. You can see that the soybeans are in triangle and the corn in a bar, and 14 and 15 were really not very good years for corn, to say the least.
About $100 of loss.
Yes, and beans were about break even of 14 compared to $100 loss for corn. Looking at 15, it's probably going to be a little bit better than what I'm projecting here because of the recent increase in prices. But again, you're looking at some higher losses for corn than soybeans. However, as you indicated, David, in 16, 17, and 18, it actually looks like corn's going a little better. Again, looking at $4 corn and $10 soybeans, corn looks a little better than soybeans in 16, 17, and 18. So perhaps we're returning to a relationship that we saw from 2007 to 2013 where corn was favored, at least on the above average productivity ground in relationship to soybeans. And so certainly a shift in the profitability of corn and soybeans. And so when we start looking at 16 budgets, we need to factor this in. You know.
It looks like 17, 18, you got about a $50 loss on beans.
Yes.
It'd take about $1 higher.
Yes.
So $4 corn and $11
Yes.
beans to bring those. So the markets will be trying to work
equilibrate.
towards that equilibrium
Yes.
over time.
And again, if cash rents don't go down, if cash rents don't go down, our break even for soybeans is more like $11 instead of the $10 that I'm showing here.
And looking at 14, 15, 16 into the future, the Ark County Farm Program has been an important part of helping bridge the gap between some of those losses and reality. What does the Ark look like as we move forward in the
Certainly
future?
with the prices that Chris was talking about earlier, the Ark County payments don't look as good for 15 for both corn and soybeans. And I think Chris has actually crunched some numbers.
Just ran the numbers, and again, this is based on the close yesterday of the futures, and who knows where that's going to be in the next few days. But we took almost half the payment out of corn for the 15 crop. This would be the Ark County program. We dropped from about $72 down to, well, about $35 out of that, so right around half. And soybeans were a little over half. So, and again, about $30 an acre. So, got higher opportunity to sell in the marketplace, but some of that's could come out of lower government payments for the 15 crop.
And that's by design how these revenue programs work, is you trade one for the other. So right now we're kind of in this trade-off zone.
I think you made a good point. We are in a price range where as you get higher market prices, you tend to get less government program. We had 98% of our farms in corn and soybeans that went into the county ARC program across most of the Midwest. So that is the way that's going to work. So farmers get excited, we got a higher price, but actually you're going to give a portion of that up in government programs.
Okay, well, we're wrapping up our time here today with you guys, and we appreciate everyone joining in. This a recording of this video will be provided online. It'll be accessible through our website. We encourage you to view this again and share it with your friends and family as you wish. Again, that'll be out in the next couple days. Two important dates to write down real quick. We invite you to the Top Farmer Conference here at Purdue University up at the Beck Ag Center. That's next Thursday and Friday, the 9th and the 10th. Information about that's on our website at ag.purdue.edu/commercial-ag. You could still register for that event. It's going to be a great 2-day event with these guys and a lot of our other colleagues joining us as well. The second event to write down is on August 7th. We're going to have another webinar featuring land values. The title of that is Up, Down, or Sideways, Where Are Farmland Values Going? So the Indiana Farmland Survey has been out and it's getting the data back. So I invite you to join those. So again, thanks to Michael and Chris. And yep.
David, I was going to comment a little bit on Top Farmer, give a little more advertisement for that, if I may.
Go ahead.
Again, that's July 9th and 10th. Chris Hurt, Jim Minter, myself are going to do a little longer term outlook in Top Farmer. So if you want to look at a little longer term perspective on prices and land values and cash rents, please come to the Top Farmer workshop. Also, we're going to be talking about adjustments to cash rent and how that fits into your budgets in a session by itself. And so I think that ought to be
some numbers there.
Yes,
aren't
that
you?
ought to be a very interesting
help them
session.
come up with how much do they have to.
And we're
adjust.
actually developing a tool with Gary Schnitke, Mike Bolge, and myself. We're developing a spreadsheet tool that you can use to look at what-if scenarios. What does cash rent need to adjust long term for me to hold on to that ground? You'll be able to hold on to that ground. And so I think that's going to be a very interesting session for those that cash rent quite a bit of ground.
I can see tenants carrying that out to their landlords and showing them on their
Yes.
laptops. You need to lower your cash rent by this amount.
Well, again, a lot of that information is available on our website, ag.purdue.edu/commercial-ag. You can also search it in your search engine browsers, and so we invite you to that in our next webinar. Thank you for joining us.
Thank you.